welcome to another episode of the IBC Guys. I'm Dave. I'm recording this episode a little later. My family is out and about. Kids are getting ready for bed. We had a good long weekend. Actually went and visited Mike Stevens in Minnesota. So did a lot of cool stuff. One of them, I don't know if you've been listening to the podcast, is puppies. Uh, I didn't get on Mike enough about this. I should have. But we successfully went out. He had 8 little Bernese Mountain Dog puppies, and we successfully made it home without getting one. So I need to rub that in a little bit more. If you've been listening, Mike thought there was no shot I could bring my family out and do that, but we did it. But anyway, we got back late last night. I'm a little behind, but I was excited to kind of share what we had prepared for this week. So I believe Mike's going to be on next week. Fingers crossed. He's been so busy. I was teasing him like, the listeners probably think, Mike, that you don't like me anymore. He said, well, maybe that's true, and then laughed. So I don't think that's true. Again, we were just at his house. Hopefully he's going to be on this week. We got something brewing. Maybe it'll just be an update. I don't know. We're going to get him on hopefully for next Tuesday. But I got a good topic tonight. This topic, obviously, if you've read the title, um, critiques claims and cash value, the IBC conversations online. This was kind of inspired by asking ChatGPT what it thought about IBC. So I went to some forums and just saw, hey, what do people think about IBC? And I picked out some of the naysayers and kind of wanted to talk through what they had to say. So we'll get into that, but I want to do the introduction stuff. IBC, this podcast, the IBC Guys, exists for 3 reasons. One is to provide as much information as we can about IBC. Um, I like to think of myself as a truthful guy. Reading these critiques, you'd think people that do this are not that ethical and honest. I try to be as much as I can. Some of that comes in. I want to give as much information I can and then have you decide yes or no. So it's not a, hey, you got to do this. I want to sell to you. I do not like the idea that I am an insurance salesman. I do not like that term. Formally, that is my title. I am licensed to do so in many of the states in the United States. But I don't like that. The goal is to get the information in your hands and then have you decide. There's no pressure there. I think I have a lot of people that would vouch for that. It's your choice. You get to make the decision, but we want you to be knowledgeable and make an intelligent decision. 2 is to provide implementable and practical examples. So what does IBC look like in real life? So this episode is not going to be so much that we're going to talk about what people are saying about it online. Online is a crazy place. There's some crazy things said. So we'll talk about that. That's not so much this episode. But the third one is to share it, get it out as far as we can. So if you would share it, this may fit somebody. I don't know if you've had a conversation with somebody about IBC and they've given a lot of these reactions that you're going to hear tonight. Share this with them. I'd be happy to have a conversation with them. I by no means know as much as Mike does. Mike has people that he calls. So I was working with somebody and I called in Yvonne. I've had Yvonne on, I think a couple weeks ago now. And she's like, well, I know exactly what to do. We're to this, 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 this. I was like, great, let's get it done. And it fit the client very well in terms of what they needed. So I say all that because I am not the most knowledgeable expert. I do have the desire to do a podcast and get information out there. That's where I come in where I provide the value. But we'll talk through these. I do believe I can speak to them rather intelligently, but maybe have a full answers. I don't know. It depends on your questions. So if you want to, give us an email. Dave at familybankingsolutions.com. Mike's is Mike at familybankingsolutions.com. It's in the show notes if I don't enunciate, which I tend to mumble sometimes. But if you could, maybe email Mike. Try and stump him. I wish he was on here tonight. He gets fired up about this stuff when people make big, bold claims and don't necessarily understand everything. I tend to be a little more tempered. Is that a correct word? I don't know. He just got that fire in his belly. He gets after it. So I wish he was here tonight. Maybe we'll ask him about it next week. But yeah, email him. Try and ask him some questions. Try and get him stumped. Maybe some of the questions that come up tonight will prompt ideas in your heads or give you the courage to write in and ask a question you've been thinking about. I don't know, just get a hold of us. If you want to call 507-205-2284. If you call or text that number, either Mike and I will answer it. Be happy to have a chat with you. All right. Critiques, claims, and cash value. I went for the alliteration there. I like to read. Seems to be a literary technique. But the IBC conversations online. So I went to a forum. It's in a rather well-known social media platform, and came across this one. I'm going to read you the initial post, asking for advice and asking for help, and then I can't go through all of them in the time frame, but I picked out some that kind of resonated with me, and what I've heard and the critiques that people have discussed with me. So I'll go through those. We'll talk about them. Kind of an informal one, but again, I wanted to get it out there. I want to be as transparent as I can. These things are being said. They're very valid. And maybe how can I help? How can I get information in your hand? And again, the goal is not to have you do a policy. So my hope is that's what you're hearing. The goal is to provide you as much information as I can so you can make a knowledgeable decision on whether or not you want to do a policy. That's the goal. So I just believe IBC is so good for so many reasons that I'm willing to do the work, put the podcast out, take questions, talk with people, to set that up, to have people understand and realize, come to their own conclusion that IBC is what it says it is. It's a contractual guarantee. I can sign the paperwork. Here are the numbers. It's not a hypothetical. Let's move forward. So that's the goal. Again, the podcast. I went through all that stuff. So let me get into it. Let me read the prompt that was put out there, and then we'll talk about some. I think I had 6 responses that I put down, and maybe I get through all 6. Maybe I don't. I don't know. All right. It says a coworker was talking about a personal finance strategy called infinite banking. The description is long and convoluted, but seems to center on an overfunded life insurance policy that one borrows against. It reminds me a bit of the buy, borrow, and die strategy. I have a feeling this sub, so again, social media platform, is opposed to the idea, which is why I came here. Can anyone explain why this is a bad idea? So again, they're biased in their question already. Tell me why it's a bad idea. Don't ask if it's a good idea. Tell me why it's a bad idea. So can anyone explain why this is a bad idea beyond a general aversion to life insurance schemes? Again, it's a scheme automatically. Is it an outright scam or just unnecessary and overcomplicated? What about in comparison to the buy, borrow, and die strategy with a traditional portfolio of stocks? So set the it's called the BBD is the acronym for it. Set that aside. That's not really a part of what IBC does. It's not a buy, borrow, and die strategy. And hopefully we've covered. If you don't are familiar with that, there's tons of. It's kind of the idea again. You buy, you borrow, and then you die, and then tax is transferred, and or you don't have to tax. It's kind of an overarching broad brushstroke. I wouldn't consider IBC to be that. So we're going to put that kind of aside. But again, that's the prompt that was written in there. So the first response that kind of stuck out to me, I'm going to read it to you. It says it's something that stupid people think they are something that stupid people think they are outsmarting the system when in reality they are losing money doing it. Period. So I'm reading the period because that was a complete mess of a sentence. But insurance companies love them. So, excuse me. I think what this person was getting at is it's something that stupid people do and think that they are outsmarting the system when in reality they are losing money doing it. The people I've talked to that have heard this podcast or have called me about IBC, I would not consider stupid by any means. A lot of them are business people, very astute at money. They want to know more about this. I don't know what system they would be considering to outsmart them. And I don't know how you're losing money doing it. So let's talk about that, losing money. So there is the idea the first year. Mike and I have talked about this significantly as well. Let's say you put $10,000 in, you only have the ability to leverage that cash value. The average is right around 60%. So you haven't lost any money. Your $10,000 is staying in that policy, making you a guaranteed internal rate of return, dividends, and interest. So it's not the greatest return ever, but it is contractually guaranteed. So the the stability, the guarantee is often attractive to people. So that money stays there. I don't know how you're losing it. Um, I mean, you get into like a variable universal life policy, we can start talking about losses at that point because those are dependent on the stock market. This is not. These are invested in tier one assets that are going to grow. And because there's a death benefit tied to it, the insurance company then is responsible to grow that money to ensure that they can pay out the death benefit when the insured dies. So I don't know where this guy comes in and say they are losing money doing it. Again, write in, let me know where your perspective is. How is it losing money? There's no commissions like the policies I do. Steve Jones, I just made up a name. Steve Jones is not paying Dave a dime. There is a commission that comes from the insurance company. Um, Again, mine are call them minimal. Well, I think they talk about this more in here. There is money that comes to me, and that does help out my family. This does not support my family, what I do in IBC. We have a land business that more than supports our family. We buy and sell land around the nation. The returns there are more than enough to get done what we need to get done. This is to help people because I believe it can change lives and building legacy wealth. But going back to the losing money idea, I don't charge any fees. If it takes you a year of talking to me, there is no cost there to you. I don't know where the loss of money idea comes in. But again, I tell me what you're thinking. Write me, let me know. We can talk about it. All right, jumping into number two. This is a little longer one. It says, despite many efforts, I can never personally wrap my head around the IBC concept. It just says it. So around it or understand it. People who promote IBC are pretty aggressive and they seem like they have not they and seem like they have something to gain. So it's a hard pass for me. From what I've seen, it seems like it may only be worth it if you have a significant amount of wealth, eight figures and beyond. But again, I don't really understand it, so hard pass. There's a lot, there's a lot to unpack in that one. So despite many efforts, I can never personally wrap my head around it. Hopefully this podcast is helpful. If you don't want to listen to me, again, I'm a ding dong. My wife will tell you that. She won't. My wife loves me and I love her. But I'm not perfect. I make mistakes. I may not explain things clearly enough. There's books for that. Talk to Mike Stevens. He's a ding dong too, but he may say it a different way. We'll get you in touch with somebody else. Let's work so you do actually understand it. That's the number one goal in this podcast. Reason number one. Let's get the information out there so you can make a decision. So this guy is already starting from behind when he types his first sentence. It says people who promote it are pretty aggressive and they seem like they have something to gain. So it's a hard pass. I can understand that. I don't we had an invisible fence guy. We got a dog. We're looking at getting an invisible fence. And he sat down on our kitchen table and it took me about 30 seconds and I did not like this gentleman. He he I won't go in. It doesn't matter. I didn't like him. So I can understand when people are trying to sell, but again, I I, I don't like to be considered an insurance salesman. I like to help people understand IBC and then leverage it. That's a client focus, not an agent focus. So I would hope I wouldn't come across as aggressive or like I have something to gain. Again, there is a commission, but let's do a policy for $100 a month. The commission, we're talking single digit commission on those things for me. Um, let's do it. I'm not out to gain anything. Um, so it says, from what I've seen, it may only be worth it if you have a single amount if you have a significant amount of wealth, eight figures and beyond. Excuse me, I got coughs. That is completely absurd. And it just shows a lack of understanding. I need to be nicer. Um, College kids are doing this. I think Mike said many times his favorite policies to write are his college boys' buddies. His boys play basketball, and he told me a story when we were out there this weekend that his one of his college basketball teammates' dad came to him because this teammate got one. It's a little policy. I don't know. He didn't tell me the numbers. But then his dad came to him and said, "Can you tell me about this?" And then they had a conversation about it. So definitely not eight figures. This family is not eight-figure family. Uh, you don't need a ton of money to do this. What you do need to do is understand IBC, which is the goal of this podcast. understand what it works to do, and that's leverage money you're already going to spend, and then learn how to route your money through it so you can capture and turn the flow of money back to your family, even though you're going to go use the money as you would have or intended to initially. So as you would have anyway. That's the goal. So again, there's a lot to unpack in that number two. But again, I genuinely just think it's a lack of understanding. My hope is this podcast helps with that. What can get you to the next step is having a conversation. So again, maybe it's begging. I don't know. Call us. We're not gonna pressure you into anything. I can, if you want some references, I'd be happy to give you those. People just said, they've helped me out. We ended up getting a policy, or I have family members like I learned about it. It's not for me. I'll be happy to give you their numbers as well. But certainly not trying to push it on anybody. All right, number three. So this person said, you came to the wrong place for insurance advice. I thought that was an interesting way to start it. So the forum is about investments. So it says you came to the wrong place for insurance advice. So they at least understand it's tied, the IBC concept is by Nelson Nash's definition tied to a whole life policy, a permanent policy. To be technical, you can run the infinite banking concept through a myriad of different vehicles. So the whole life policy is the best. I think someone refers to it if I remember correctly in one of these next ones. But at least this guy understands it's run through an insurance policy. The beauty in that is there is life insurance tied to it. That's a beautiful thing. So let's keep reading. You came to the wrong place for insurance advice. In general, you probably shouldn't worry about infinite banking. A corporation might use whole life policies in their business insurance planning process that would give them access to cash values if they need it. For regular folks, buy term if your insurance need is temporary. Again, I just copied and pasted these things. It's a hot mess in grammar and punctuation. But for regular folks, should be a comma, buy term if your insurance need is temporary, i.e., family protection, income replacement. Buy permanent insurance if your insurance need is permanent, i.e., in a state that needs liquidity to pay taxes, lawyers, and wants to avoid the sale of hard assets. So all those things are true. You can, when that death benefit's paid out, there's no taxable event in it, and the money can be used as needed. So you can pay lawyers, you can pay taxes. There won't be any taxes on the IBC policy itself. There's maybe taxes in other areas, but avoid the hard sale of assets. So you can absolutely do that. But this to me reads, and the reason I put it in here, it reads like rich people do permanent policies. Your permanent policy does not have to be big. In other words, I think the guy referred 8 figures. Now, if I do my math correctly, that's like $10 million at minimum. Dave probably does not have $10 million, and I have 5 permanent policies. I would tease my kids. Yeah, I have 900, 9,999,000, right? No, I don't have that either. But you don't have to be rich to have a policy. So to me, that reads as though this person, the term insurance, and if you need temporary insurance, term can be great. Get a 1-year term insurance. If you're younger, it's going to cost you minimal. If you are 75, it's going to cost you a bunch of money to do term insurance. A permanent policy grows with you and lasts the entirety of a lifetime. So there is a portion of continuing to have to pay premiums, but I think we've talked about this on the podcast. As your policy grows, that growth can then go fund the policy, and that thing just recycles itself. And you don't have to pour any new premium into it if you choose not to. You can. It makes your policy grow. It infuses it with cash value. And the more money that's in there, again, because it's uninterrupted exponential growth, it's going to grow faster. So it's a good idea to do it, but you don't have to. There's flexibility in that. So again, I put that one in there because it read to me as if this person believed that to have a permanent policy, you need to have wealth. And maybe not. Maybe you hear it differently. Taxes, everybody has taxes. Lawyers, not everybody needs or has a lawyer and wants to avoid the sale of hard assets. So a lot of times people have homes and things like that, but hard assets, again, the definition of what he means there, I don't know. But you don't have to be rich to have a permanent policy. All right. Number 4. This one's one of my favorites. These are all my favorite. says money sticks to the fingers of the insurance seller in commission and interest. I read that with some oomph because I'm guessing that's how it was intended. So money sticks to the fingers of the insurance seller in commission and in interest. What a racket. Pay interest to borrow one's own money. So I'll add some sound effects in there. Some harumphs, some stomping of feet. Man, money sticks to the fingers of the insurance seller in commissions and interest. I don't see $1 of anyone's policy. So again, I get a commission from the insurance. I don't have anybody. I know guys who do IBC that just sit down with them. It's $500 for the first hour to get things rolling. So the first meeting's $500. I don't do those things. So I don't. The money doesn't stick to my fingers. And to pay interest to borrow one's own money, that you're not borrowing the money you put in there. So let's be clear. There's some clarification that exists here. Again, use the number $10,000. You put the $10,000 in there. That $10,000 stays there in whole, every penny, making you dividends, interest, and an internal rate of return. They do let you borrow against the cash value. So that premium elicits a value of cash, a cash value. And because you have a death benefit that's contractually guaranteed, that is collateral, they allow you to borrow the cash value and go use it for what you were going to anyway. So there is interest that's charged on that, but the money you're making, the interest you're making on your $10,000 is going to be greater than any interest that you're borrowing. And you can't, so let's say you put in $10,000 and you borrow $3,000. So you're paying less interest than you're making on your $10,000. Let's say your $10,000 making 5%. The $3,000 you borrowed is you're being charged 4%. I would do that all day if that was my only option. Okay. I'm making money on 5% on 10,000 and I borrowed 3,000 to go on vacation or pay my home insurance or my car note, whatever it is. I don't know. It's the math is there, is my point. So you pay interest to borrow one's own money. What they conveniently left out is, one, you're not borrowing your money. That's staying there. $10,000 are on the ledger. You're borrowing against the cash value. You're using the insurance company's money because the collateral is the death benefit. So if you die, any outstanding loans that you have are just paid out of the death benefit because it's contractually guaranteed. They're okay with that. But they conveniently leave out in their statement that your money stays in there making you dividends, interest, and a guaranteed internal rate of return while it's happening. So it's not just the negative. Pay interest to borrow one's own money. What a racket. You're making money as you do it, and then you can use that money to go do anything you'd want. One thing I did put in here, someone commented under that comment, and they say, you do this already when you use a home equity line of credit. So let's talk about that real quick. I mean, I've used a home. I have a HELOC, so that stays open. You can move money in and out. So if you're not familiar with that, HELOC stands for the home equity line of credit, and essentially you have equity in your home that you've paid off, and they allow you to borrow. You pay interest on borrowing that money, and you can go use it. And then ours is set up. You can, if you choose to, have the money out for 10 years, just pay interest on it, and then after that 10th year, you're paying your P&I back. But two misnomers in that. One, your home equity line of credit, if you borrow money, that money that's in there, your equity is never making you money. In an insurance policy, if I put $10,000 in, I'm making, let's say, 5% again on that money. Contractually guaranteed, it's going to grow, and it's going to grow uninterrupted for as long as I have it in there. It's going to keep add to the next year's 10, the next year's 10, the next year's 10. So after 10 years, there's $100,000 in there making me dividends, interest, and a guaranteed internal rate of return. Even if I've leveraged some money to go buy land or to go do whatever, buy a boat, I'm never going to buy a boat. The best kind of boat is somebody else's boat. But my point is, in a HELOC, your money, the equity in your home is not making you money. So there's one thing. Two, your home equity line of credit doesn't have the insurance component tied to it. So we talk about infant banking, 95% of the time, there's a death benefit that's tied to it. And that's a beautiful thing. So if I, die in a car accident or have a heart attack, my family is going to get a significant death benefit that's going to help them, with needs for a long, long time. Your home equity line of credit does not do that. So again, this guy chirps in, you already do this when you use a home equity line of credit is not, the idea of leveraging some equity, I guess, but it is not the same thing for those two big reasons. There's little ones as well, but those are two big ones. All right, this next one's rather long. Um, I don't know how much time I got left. We're gonna go with this one and see what happens. All right, this one is 1, 2, 3 paragraphs. Big one. All right, it says the high level problem is that you're involving someone else in your money. They have to take a cut. The entire bogglehead thesis, and I don't know what the bogglehead thesis is, so you can look that up and tell me, is that they have no special investment trick that can get higher returns, keep part of the excess, and you both win. It won't happen. For them to even break even, you have to come up short. Okay. The mathematical devil is in the details. It would be possible for a policy to be good for you. No such policy can be found, though. Anyone who offers I assume a policy, it just says it. Anyone who offers it would go bankrupt and out of business, and in all likelihood would be in violation of the heavy regulations on life insurance. And simply, you pay money in order to be able to borrow money to have it keep growing. But free money would mean you could roll that into another life insurance policy for infinite banking. Which can you borrow against to roll it into another policy? An infinite money machine? No. The premiums and fees mean you never come out ahead. You lose money at each step. So again, we got to get these guys and gals, I assume it's both, back to high school to be able to write a sentence. Jeez Louise. So I don't know. Maybe that's me to me. Maybe you're agreeing with them. I don't know. I just find those hard to read. But let's talk about that one. So a high level problem is that you're involving someone else in your money. Let's talk about that. How many people have financial planners? Is that involving someone else in your money? Let's talk about investing in a stock. I own stock in Nike. I bought one share back when I was 10. That is, I don't know how, I think it was $100. I think I haven't touched it. I just had the dividend strip. I think it's worth like $6,500 at this point, which is great. But I'm 42. That's 32 years, and I've made $6,400. Probably could have done better leveraging that $100 another way. But my point is, I invested in Nike. There is how many, board members are there in Nike making decisions? Good old Phil Knight. I don't know if he's still doing stuff. By the way, this is a complete rabbit trail. If you haven't read the book Shoe Dog about the Phil Knight story, how he founded Nike, it's a great read. I would highly encourage you to go do that. But you're constantly involving someone else in your money. If you put your money in the bank, you're involving someone else in your money. So that statement is asinine to me from the onset. I don't like it. They have to take a cut. The bank is taking a cut. So if you put money in there, and Mike gets going on this stuff with the fractional banking system and all that. He told me it's controversial. I don't understand the controversy. It's a scam, but that's for me. And I use the bank. We have several accounts for our business, some personal accounts. I think it's a necessary evil. So we certainly use it, but you are involving people in your process and they are taking a cut. That's why banks exist. And they can say, well, that's why insurance policies exist. 100% agree. There is benefit for both parties. The goal of an IBC, and if your agent is doing what he or she should, they are building you a policy that is focused on the client and the growth of the policy rather than the agent's individual and respective commission that comes from either the client or the insurance company. So I'm not going to sit here and say there isn't some monetary compensation that exists in doing a policy. There absolutely is. But to say that the entire premise is to get a cut, that's certainly not my goal. I have been, privy to some insurance policies where it's not a good look on who designed the IBC policy. I wouldn't even necessarily consider them IBC policies. It's a whole life policy. This does its job, but these are specially designed whole life policies. And if they're done correctly, the client is going to benefit more than the agent, maybe is a way I would put it. So jumping down, the mathematical devil is in the details. I would agree. It is a unique concept, the IBC policy and how it works. It's very difficult in this forum go through all that stuff. I've had comments, Dave, you need to go deeper on your podcast. It's really hard to do that if you're simply listening, so there's no visual. And to answer, a respective question, people, the more they understand, the more refined their questions get. Without a given example from a respective person's life, it's very difficult to answer that question. So one person's question may not be the other person's question. So Mike and I have discussed this, try and take the funnels broad, and maybe we go down a little bit. But as you go down that funnel to where it's coming out the bottom, that is where the respective individual questions come in. And the only way we can answer those is if you're reaching out. So please do so. But the mathematical devil, going back to the statement, the mathematical devil is in the details. It is complicated. It took me a long time to wrap my mind around it. And I still ask questions. So my hope is that you continue to learn as well. But there is a policy that is good for the client. I would argue IBC is. It says the next sentence, it would be possible for a policy to be good for a client, but no such policy can be found. I would disagree with that. Anyone who offers it would go bankrupt and out of business. So there is a cut, but again, the bank's doing the same thing. If you're investing in stocks, mutual funds, those companies are taking and leveraging your money. So I would argue it's similar in that we only use mutual companies though for insurance. So in fact, I just got something in the mail that they wanted me to vote on the board members for a given company because one of my policies is with them. I don't know those board members, but I got that letter because as a mutual company, I'm technically an owner. It's kind of like buying a stock in that idea. Like technically own a almost an incalculable amount of Nike, very, very small. But technically, I own part of the company. So, with that in mind, I guess you could say people are in it for maybe bad reasons, but because we build them the way they do, because we use the companies we do, the idea is to build them so the client benefits much, much more than the agent. So last thing here says, and simply you pay money in order to be able to borrow money to have it keep growing. I disagree with that. You can have your money grow in different avenues. The statement that comes to my mind, I mean, if you're going to go invest in the stock market, that's great. Run your money through a policy, have it on the ledger, making you dividend interest, go invest it in the stock market, have it grow there. That way your money is making money, it's making money. So rather than just making money in the stock market, have it make money in both places. Then as you make money in stock market, let's say you take your dividends and you don't drip them, you just put them back in your policy. Now you have a cash reserve that when opportunity comes, and usually people are quote unquote lucky because they seize opportunity when it presents them, but they also presents itself, but they also have the means and capability to go after that. You start building that cash value up and you can go leverage it in different capacities. Again, the land business. If I put my money back in, now I have money available and ready to go buy a new piece of land. When that land makes me money, I can take the excess, stuff it in. Let's say my bank's not big enough. Now I can consider starting a new one or go buy another property with what doesn't fit my bank, but now I have a reserve of money for the next time I need to go buy property. So to say, and simply you pay money in order to be able to borrow money to have it keep growing is not completely true. So it's not a money machine. I'm reading through the rest of it. No, the premiums, fees never have you come out ahead. There's no premiums, there's no fees for me ever. The insurance company, like the fees that come in mind, if you pay monthly, there's like an $8 fee each month for processing and stuff like that. But the first few years, it does take, you're paying for the cost of insurance. But then once you hit year 4, your policy can start funding itself. And then I don't know, I went through this on one of them. I forget, it depends on the policy itself. But let's use year 20. Year 20, every dollar you put in now, you're getting $2 out in cash value. So as soon as you put it in, you've instantly made 100% on your money. That I wouldn't consider as the premiums and fees mean you never come out ahead. That is direct contradiction to that statement. So, all right, last one. I don't know how much time we got left. Looks like we got time. Perfect. All right, number 6. Insurance programs can transfer risk from some scenarios into lower returns on others, but it's not sure. I doubt this infinite banking, it's in quotes, is one of them. Banking is something people should do less of, not more. So again, I just copied these verbatim. So going through the first one, insurance programs can transfer risk from some scenarios into lower returns on others, but I'm not sure. So the way that reads to me, and you may feel differently, the way that reads to me is insurance programs transfer risk. That's what insurance is. It transfers risk. So transfers risk in or from some scenarios into lower returns. So I read that as if you buy insurance, you get lower returns, and I would tend to agree with that. If you're looking at this simply as an investment, you are looking at it incorrectly. This is not an investment. IBC is not an investment. It is a way to monetize money you're already going to go spend. But the returns, you can do greater returns in other places. My land business is an example. Our returns are significantly different, significantly bigger than the money I have or the returns I get on the money I have in my policies. 100% true. So you can go make more money faster in other areas. Completely agree with that. But the idea is not to invest. The idea is to route your money through a policy and then go use it how you were going to anyway. So again, we route our money through, I get it on the ledger. I then go buy my land to sell and do in our system in our land business. Over the course of time, though, all the money I've routed through that policy is going to grow and grow and grow on that ledger. And that ledger is then going to make me interest uninterrupted over the course of 20 or 30 years. That is a significant amount of money. Then when I pass away, the death benefit then goes to my wife. She's my main beneficiary. And the secondary is the trust. They get a windfall. So I'm not only setting them up for success when I do pass away, but as I'm alive, my money is continuing to make money on itself, even though I've gone and leveraged it somewhere else. So I think that's what this first sentence is trying to get at. There are lower returns as you transfer risk. That's what insurance is. So I completely agree with that one. It says, but it's not a sure thing. So read it the sentence in full. Insurance programs can transfer risk from some scenarios into lower returns on others, but it's not sure. I disagree with that last statement. The policies we design are contractually guaranteed. If you get into an IUL or a VUL, those are not guaranteed, and I can show you where. So I personally would be very hesitant. IULs can be for a very select few be the method or the product I would suggest, but we're talking less than 1%. If you want a contractual guarantee, which is where I live, like I want to know what's there, the policies we design are where it's at. So I would disagree. It's not a sure thing. So that last statement I disagree with. Now he goes on and writes a second sentence. I doubt this quote unquote infinite banking is one of them. Banking is something people should do less of, not more. If you can't see me on the YouTube, I got my arms out. This is why I put this last. This guy has no idea what the infinite banking concept is. My guess is he doesn't really understand what banking is in and of itself. Because banking is something people should do less of, 100% agree. But when you have a catalyst, when you have a vehicle, when you have the ability to turn that money making opportunity around for your family to benefit rather than a bank to benefit, you absolutely want to do more banking, not less of it. You want to do more and more and more because I am earning money. I am both the bank and the lender in these situations. So I am earning money off both situations rather than just saying banking, let's do less of it. Just go spend your money. No, I'm the bank. So I'm going to earn the money that's deposited into my bank as well as I'm going to earn money of the money that's lent. So I'm going to borrow against my cash value. I'm going to pay myself back just like I would any car note, mortgage, something like that. And that money is going to grow uninterrupted with a guaranteed internal rate of return, dividends, and interest. So we absolutely need more banking if you have the correct catalyst. So if it's just traditional banking, I agree with the statement. Do less of it. But because we have something that turns traditional banking on its head and allows you to make money as the banker, you need to do as much of it as you can, do as much as possible. So I wanted to end with that one. Excuse me. Those are just some things that online, I maybe depending on the reaction of this, do some more. There's certainly tons out there. I've sent YouTube videos of people saying how stupid IBC is. I mean, I understand it. When you don't have a complete understanding of what IBC does, I can understand it. What I respect is when the person has an under. So you can tell when someone understands IBC. When someone understands IBC and then doesn't recommend it, I'm all behind that. And I've sent a couple of those videos to people. Like this is someone who's very intelligent about it and chooses not to run their money through. And here's the reasons why. Again, we want to provide as much information as we can. One big name comes out. I won't say his name. He's very good at helping people get out of debt. He is against the infinite banking concept. I would argue he does not understand, and I can show you and give you reasons why I think he does not understand. He does not understand the infinite banking concept. So find me someone who does and then says it's not worth doing, and that's a great discussion. So we'll end on that. Hopefully, this brought some questions up. Maybe it got you fired up a little bit. That's great. The passion in your belly gets you a little angry. I'm all about that. That means it matters to you, matters to your family, how you're setting them up for success later on. Let's have a conversation. Give me a call. Geez Louise, I don't remember the phone number. Never do. 507-205-2284. You think I'd know it by now. But I'm Dave at familybankingsolutions.com. Mike is Mike at familybankingsolutions.com. Shoot us an email. Our socials are in the show notes. But yeah, critiques, claims, and cash value. Hopefully it brought some ideas up, some questions up. Reach out, give me a shout. Let's talk. Be happy to do so. You know where my stance is in IBC. I'd love to hear yours. And if we have a conversation and you say it's not for you, I'm going to give you a Zoom high five and we're going to be buddies still after that. So hope this again was worthwhile. Thank you for listening. If you're watching, thank you for watching, and we'll catch you on the next one.